Welcome to this week's episode of the End of Year Financial Planning. We're going to look at trust disclosures. This may seem like a bit of a strange topic, but a lot of people that own businesses also have trusts, and there's been a lot of changes in the last few years. So, with the new reporting requirements for trusts introduced in 2021, there's been minimum reporting requirements. So one of these is the need for profit and loss, balance sheets, detailed beneficiary accounts, and associated person transactions. So even if you've just got a small family trust with your family home in it, it would pay to see your accountant or talk to your lawyer about whether or not your trust is still appropriate and what you really need to do. So Exposure Draft 235 of Trust Disclosures is for the 2021-22 income year, and this is to be filed with your tax return. So you may have come across these disclosures, but effectively each person with the power to appoint or dismiss a trustee, to add or remove a beneficiary, or amend a trust deed needs to be disclosed. All information regarding settlements also needs to be disclosed. So that includes the name of the settler, the amount and nature of the settlements, and also your trust will have to provide a profit and loss and balance sheet. So all settlements and distributions need to be disclosed. They require the name, IRD number, date of birth of the relevant beneficiaries, profit and loss statement, and a balance sheet. So slowly, more and more disclosures are going to be required by IRD. These will no doubt change the tax return form that you normally do. IRD can also ask for other information going back to 2015. This must be in a list prescribed by the Commissioner though. So we'll look at an example here. The Cherry Tree Trust credits $100,000 of beneficiary income. So in this case, we'll say that they've got rental income that they're allocating to Lucy Cherry's beneficiary account. Cherry withdraws $15,000 from the trust. So you'll need to disclose the nature and the amount, which is the $100,000 that's credited, and that it was rental income. This also needs to be with Lucy's name, date of birth, IRD number, and tax residency. In Lucy's IR3 tax return, you'll have to disclose the $100,000 as income in the appropriate box. So, as Lucy is owed more than $25,000 at the end of the financial year, and no interest was paid on her beneficiary current account, she's deemed to now be a settler of the trust, and all her details will need to be disclosed. So the $25,000 rule is one that came in last year. Trust laws can be really complex, and the reporting requirements can be quite difficult, so it is recommended that you speak to an accountant. Just a note that these disclosures don't apply to non-active trusts. So these are trusts with effectively no income. So if you just own a family home in your trust, these disclosures won't apply. However, if you have a trading trust or a trust that owns rentals, these disclosures may apply, so speak to an accountant. Thanks for joining us on this week's episode. You can find us at Instagram at @BizGirlBlog or else on Facebook. Check out our other episodes in this series about financial end of year planning. Also, check out our website bizgirl.co.nz.